I think the gold price will stay high and most likely go higher. The reasons include the following. First, we have the geopolitical tensions which are rising. We have the government debt, which is huge and unmanageable. And we have some uncertainties regarding the dollar. So those are the reasons to be fearful and want to move into something different from fiat money.
Gold's upward trajectory in 2025 shows no signs of slowing, and the reasons are stacking up. Geopolitical tensions are escalating, government debt is at unsustainable levels, and uncertainty surrounding the US dollar is prompting investors to seek safety in alternative currencies. In such an environment, gold's role as a hedge is once again in the spotlight. Clive Thompson, a seasoned market analyst with decades of experience tracking macroeconomic trends, points out that the gold mining sector is uniquely positioned to benefit from even modest shifts in capital. Compared to tech giants like Microsoft, Apple, and Nvidia, the entire gold mining sector is relatively small. In fact, each of these companies individually exceeds it in market value. This imbalance means that if even a small fraction of investment money were to rotate from technology stocks into gold miners, the impact on gold mining valuations could be explosive. Currently, large miners are in better financial shape than they've been in years, with low or no debt, substantial cash reserves, and operational discipline, having endured more than a decade of market neglect. This year alone, gold has risen by roughly 26%, increasing from around $2,658 to $3,360 per ounce. Many analyst forecasts for mining company earnings were made when gold was far lower, meaning they underestimate potential profitability at today's prices. Institutional money is quietly returning to the sector after decades on the sidelines. When the broader investing public catches on, likely within the next 2 to 3 years, the resulting demand shift could reshape the market landscape for miners. Given the sector's small size, even incremental inflows could push valuations sharply higher. Now, we present the clips from Clive Thompson's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
Let's look at this slide on the screen, which lists the largest companies in the USA. As you can see, there's about 14 companies which are larger in size individually than the entire gold mining sector. So for example, Oracle at $713 billion is larger than the $691 billion of the gold mining sector. So is JP Morgan Chase, Walmart, Berkshire Hathaway, Tesla, Taiwan Semiconductor, Broadcom, Saudi Aramco, Meta Platforms, Amazon, Alphabet, Apple, Microsoft, and Nvidia. All of these companies are much larger than the entirety of the gold mining sector. For example, Microsoft alone is 6 times the value of the entire gold mining sector. What does this mean? It means that if a very small amount of money were to leave the technology sector to enter into the gold mining sector, it would probably have little or no effect on the technology sector, but on the gold mining sector, it would have an extremely leveraged effect because of the tiny size of this gold mining sector. I believe that this is something which is just about to happen, and I'm going to show you why in a minute. But first, I want to take a look at the gold price and what I think is likely to happen to the gold price given everything we can know about the world today. I think the gold price will stay high and most likely go higher. The reasons include the following. First, we have the geopolitical tensions which are rising. We have the government debt, which is huge and unmanageable. And we have some uncertainties regarding the dollar. So those are the reasons to be fearful and want to move into something different from fiat money. Now let's look at the gold mining companies in general. The large miners are in very strong financial shape. Having gone through the doldrums for the last 15 odd years, they've been conserving cash, paying off debt. So for the most part, they have little or no debt, and in many cases they have large cash balances, which are war chests which can be used in case of need or to buy something else. The gold mining sector has been ignored for years. Investors have been chasing AI, technology. The consequence is that gold mining stocks have become very undervalued. Now, this year, the gold price has risen by 26% so far. It's gone from $2,658 to around $3,360. What that means is the price forecasts made by the analysts are largely out of date. Most of these forecasts were made much earlier in the year when the gold price was lower, and they assumed that the high price they were seeing already then was just an anomaly and would go back to some sort of normality. So when they forecast future earnings per share or future sales or the future share price, they were working on an assumption of the gold price being much lower than they would probably work on if they were to do the maths again today. So as I say, gold is up 26%, and most of these forecasts were made at a price when the gold price was much lower. That's the forecast of the earnings of the gold mining companies. Next point, I think that institutional money is probably returning to the gold mining sector after decades of neglect. Now we're looking at a chart of the gold price since 1968. It's the area chart with a white top and coloured light green. As you can see, the gold price is up 9,500%, or put it another way, it's up about 95 times the $35 price in 1968, 1971. So the gold price has gone from $35 to nearly $3,500. That's 95 times as much as it was, nearly 100 times as much as it was. And put into percentage terms, that's a gain, a profit, for those who held it throughout the period, of 9,500%. But on the same chart, you can see the chart of various gold mining companies going back as far as I can get the data. So the first one at the top on the right-hand side in orange is AEM. That's Agnico Eagle Mines. And you can see that Agnico Eagle Mines have risen by about 4,500%, half the rise of gold since 1968. The next one down is, it's letter B for Barrick Gold, or Barrick. It used to be called American Barrick, and the symbol used to be ABX, but it's now just the letter B. So Barrick is up about 3,500%, much less than the 9,500 of gold. And below that you can see WPM, that's Wheaton Precious Metals, and their share price is up close to 3,000%. It's 2,900 and something. Below that you see NEM, which is Newmont Mining. Newmont is up very roughly about 435% since the chart starts for Newmont. It doesn't actually start in 1968, I don't think. The next one you can see is the GDX. That's an exchange traded fund which holds all the largest gold mining stocks. So it is the average of them all. And although that particular line starts in 2006, since 2006 it's only up about 40 or 50%. But let's look at the chart since the global financial crisis. 2008 was the global financial crisis starting, and this chart goes from 2006 onwards. Here you can see that gold has also outperformed almost all the gold miners. The one exception is Wheaton Precious Metals, which has massively outperformed gold, but it's up 1,000% compared with gold's 450%. But all the other gold miners, including the GDX, the ETF, have put on a pretty mundane performance of between 0 and 300%. So gold miners have been lagging over the long run the gold price. People haven't believed that the rise in gold will be reflected in rising share prices or rising earnings of the gold mining companies. But we're going to look at a much closer picture for the current year, 2025, from the 1st of January. Again, the gold price is the green shaded area at the bottom with a white line on the top. And the other 5 lines are the 5 gold mining stocks, all of which this year in 2025 have been outperforming the gold price. Now, this is why I think that some money has started to flow into the gold mining stocks, out of probably the technology sector. So those people who are in the know are now starting to buy the gold mining stocks, which are massively undervalued, and they're starting to put money in, and this is just the beginning. Wait till the public at large wakes up and starts to do the same thing, which will probably be 2 or 3 years from now. So this tells me that a little bit of the smart money is starting to shift away from the overpriced technology sectors to the heavily undervalued gold mining sector. Now remember, the gold mining sector is tiny. It's even a tiny fraction of the size of a big company like Microsoft. So a little tiny trickle of money out of the technology sector or the AI sector into gold miners would make a huge difference to the gold mining stocks. It would push them a lot higher.
Beyond the gold sector's potential, recent macroeconomic data have shifted the conversation on interest rates. The July Producer Price Index (PPI) came in at 0.9%, triple the expected 0.3% increase. This was a sharp reminder that inflationary pressures are not gone, as higher producer prices often lead to higher consumer prices down the line. Breaking it down, final demand services rose 1.1%, while goods rose 0.7%, both well above forecasts. This unexpected spike has directly impacted market expectations for Federal Reserve policy. Just days ago, the probability of a rate cut in the upcoming meeting was priced at 100%, with a significant portion of traders betting on a half-point cut. However, after the PPI release, the probability of a half-point cut collapsed to zero, the odds of a quarter-point cut fell to about 93%, and the chance of no cut at all rose to nearly 9%. One might expect such a hawkish shift to trigger a sell-off in interest rate-sensitive sectors, such as technology, which thrive in lower-rate environments. Yet the reaction was muted. The Dow slipped only 0.02%, the Nasdaq edged down 0.04%, and the S&P 500 notched another record high. The lack of selling suggests that investors remain confident in the tech sector's growth story, despite reduced expectations for rate cuts. However, this environment could favor gold miners. With inflationary pressures visible and rate cut hopes fading, the appeal of tangible, scarce assets is likely to grow, especially among investors seeking insulation from both market volatility and currency risk. Let's get back to the interview.
The big news last night was the Producer Price Index, which came in at a much higher level than expected. It didn't affect stock markets much, but it certainly changed all the expectations about interest rate cuts. So the Producer Price Index for the month of July increased by 0.9% compared with what was expected, which was just 0.3%. So this was shocking news on the price front because it shows that because the producer prices are rising, which obviously is a forerunner to what's going to happen to consumer prices further down the line, because producer prices raise, then the consumer prices get raised later. So what it showed, if we break it down a little bit further, is that final demand services increased 1.1%, and final demand for goods, these are producer goods, increased by 0.7%. So both particularly high numbers, higher than expected, and that tells us that inflation is coming down the line. And the impact of this is what the Federal Reserve are going to do on interest rates, because it looks like inflation is going to start rising. So whereas a few days ago we'd seen that the possibility of a Fed rate cut had risen to 100%. So if we go back actually a month ago, before the Producer Price Index, we had the probability of a cut at 55%. A week ago it was at 88%, or going on 90. Yesterday, the probability of the cut was showing it, before the Producer Price Index, was showing it 100%. Not only 100%, but there was 94.3% probability of a quarter point cut, and nearly 5.7%, nearly 6% probability of a half point cut. But today, The probability of a half-point cut has gone to 0. The probability of a quarter-point cut has gone to 93.1%. That's a few minutes ago. And the probability of no cut at all, i.e. leaving interest rates where they are, has risen from 0% to 8.9%. You would have thought that we would have had a large negative reaction on Wall Street to that news, especially in sectors like the technology sector, which are very interest rate sensitive. Obviously, technology stocks, they benefit from lower interest rates because the opportunity cost of holding something which does not pay dividends, and most tech stocks don't pay dividends, or they pay very low dividends, the opportunity cost of holding something without dividends goes down when interest rates are reduced. But the expectations were not that interest rates will reduce, but or they were lower, that they'll reduce, and certainly not reduce as much as the market hoped. So tech stocks should have gone down, but they barely changed. There was some sector rotation. Defensive sectors like utilities and consumer staples slightly outperformed. Growth-oriented technology stocks slightly underperformed. The Dow Jones Industrial Average, for example, had a modest decline of 0.02%, almost nothing. The S&P 500 had a very, very modest decline. I'm just checking it over here. It was, I think it was 0.03%. In other words, it was a slight increase, 0.03%. Another all-time record for the S&P 500, the 18th record this year, but the size of the change was hardly anything to write about. Nasdaq, the composite index, showed a slight decline, almost nothing at all, 0.04% down to 21,704. So this kind of shows us that investors don't really care as much as they should be caring about interest rate expectations. They think that the strength of the technology companies will continue to see them good, and they're not selling in the light of this fairly negative news last night.
The muted reaction of equity markets to the latest inflation data masks a significant shift underway beneath the surface. While most investors remain fixated on technology's dominance, a slow but noticeable shift into undervalued sectors, such as gold mining, may already be underway. The combination of high geopolitical risk, persistent inflationary pressures, and the sector's small market size relative to potential inflows creates a powerful setup. History reinforces this perspective. Gold has risen nearly 9,500% since 1968, yet many leading mining companies have lagged far behind that performance. This disconnect stems partly from decades of investor skepticism, where gains in the gold price were not fully reflected in mining stock valuations. But in 2025, the pattern appears to be shifting. Miners are outperforming gold year to date, a sign that the smart money is beginning to reposition. As broader market conditions evolve, the case for diversifying away from overvalued tech and into hard asset plays strengthens. Unlike speculative growth stories, gold miners produce something tangible with enduring value. Their improving balance sheets and operational resilience position them to benefit disproportionately if gold continues its climb. For investors willing to look beyond the market's current darlings, the opportunity in this overlooked sector could be significant. As history has shown, capital rotations often start quietly before accelerating rapidly when sentiment turns. In a world of rising risks and eroding confidence in fiat currencies, positioning oneself early can make all the difference. If you found this breakdown insightful, please like this video, subscribe for more in-depth market analysis, and share your thoughts in the comments. Your engagement helps us continue to deliver independent financial insights.